We're gonna go ahead and get started. So my name's Melina Flabiano, and I lead the New York City chapter of the Wharton Alumni Founders and Funders Association. So what that is a nonprofit that is focused on connecting female founders and investors. And what it really spawned from is we found that in the Penn and extended community, founders make up only 13%. Female founders make up only 13% of founders and receive only 6% of investment, which is pretty sorry statistics. And in the broader world, it's actually even worse. So we're a group of Penn alumni that has gotten together to put on a lot of events, and in the pre-COVID world, in-person events, for now just virtual, but connecting women with resources that can help in either the founding or the funding dimension. So today we're really excited to be hosting Angela Lee, who you may know as a founder of 37Angels. She's going to talk to us about the art of angel investing. And I'm going to pass it off to her now to introduce herself and kick it off. Thanks, Angela.
Thank you so much for having me. Yeah, so by way of introduction, I am a founder first. So started several companies, the first one during the dot-com boom. And 7 years ago, started 37Angels in a response to kind of a personal problem. I would say two. The first is I kept walking into rooms of people who didn't look like me. So I started angel investing 12 years ago and literally got asked questions like, are you lost? And whose money are you investing? And all these really fun questions. And so that was one. I wanted more to invest alongside people who look more like me. And then the second thing was I really wanted to create a safe place for people to learn. I'm a professor full-time, and so I'm at Columbia Business School. I teach venture capital courses, leadership courses, and strategy courses, and I really wanted a safe place where people could ask all those dumb questions like, what's a liquidation preference, and what's a convertible note, and what are pro rata rights, and all those things, because I had to figure all those things out by reading countless articles and asking questions and furiously Googling every time I went to an event to try to figure out all these different things were. So that was 7 years ago. Fast forward, we now have 85 female investors, largely in New York City, although we are gender agnostic on the founders. We invest in male and female-led startups. And we also offer an investment boot camp where people learn how to become an angel investor. So we offer 3 a year in person in New York, obviously not right now, and then we offer it twice a year online. And so that is my background. And so I was planning on really just answering 2 questions today. The first question was, what do investors look for in diligence? And then the second question was, if you are thinking about starting to become an angel investor, what are the questions you need to answer for yourself? So that's my plan. That said, I want this to be very interactive, and I want folks to ask questions. So there is a Q&A box. You can throw questions into the Q&A, and that way I'll respond to them. We have lots of time built in. Don't feel like you have to wait until the end. Please ask questions throughout, and I will try to answer them as they come in. That's one thing. And then the second thing is I want to get a sense of who is on the call right now, because I can tailor it a little bit more or less depending on where folks are. So I am launching a poll right now, and you should see, just want to get a sense of what are folks' backgrounds. Are you mainly here kind of as a founder, understanding the investor perspective? Are you mainly here because you are an aspiring angel investor? Are you kind of wearing, both hats? If you work in venture capital, I just want to get a sense of who's on the call in the mix, and that way I have the sense of what might be more or less relevant. It sounds like somebody isn't getting audio. My sense is that might be something on your end, because it sounds like folks can hear me on this end. Okay, so pretty good. I'm going to stop the polling now. Not everyone has responded, but about 80% of you, so good, you're all paying attention. So you can see about a third of you are founders, but a quarter of you are angel investors, and we kind of have the mix of the others. Great. So that is helpful for me to know. Okay, So just to make sure that we're all level set on the difference between venture capital and angel investing, I realize this is very basic for some of us, but just to make sure we're all on the same page. The primary difference between venture capital and angel investing is who is making the decisions. So on the venture capital side, you have a GP, a general partner, and a number of LPs, limited partners. And what that means is if I were the GP of the fund, and you were all limited partners, I would have about 100, and you each give me $1 million to invest, I would have a $150 million fund. And so as the GP, I decide what to invest in. I decide these are the best startups that I'm gonna go out there and source and pick, and you are trusting me to make investment decisions on your behalf. So that decision-making power is really consolidated in the GP, the general partner. The way it works with angel investing is the decision making is a little bit more spread out. And so usually it's individuals investing their own money, their own savings into startups, and you have a lot more control over that. And so, and I'll talk a little bit more about that in a little bit, but that's the primary difference. So it tends to mean that VCs have more capital to deploy because most of us don't have $150 million to deploy. But it does mean that with angel investing, you have a lot more autonomy over what you invest in. And then it also means that the financial incentives are very different. So the way venture capital works is typically it's I as the investor get 2% of assets under management. So if I have a $150 million fund, every year I get paid $300,000 for managing that capital, and I get 20% carry, meaning if I turn, if I make $100 million on that fund, I get to keep 20 million and I distribute the 80 million to my LPs. So that's how VCs make money, and the way angel investors make money is typically through dues. So most, I am happy to share the slides. There's that question. Most angel networks charge, I would argue, between $3,000 and $5,000 a year. I know that there obviously is a Wharton angel network, and usually the university associated ones charge less. So my guess is they charge less, but I would say most of the professional angel networks are charging kind of $3,000 to $5,000 a year. So that's the way the difference between venture capital and angel investing. And I would really encourage, for those of you who are interested in doing this, just make sure you find your tribe, right? You find folks that you want to get to know. So whether that's maybe working, Wharton has a grant entrepreneurship program where I get to know people at the university. Maybe it's working with a law firm, right? And the law firm is kind of your tribe, and they're the ones who are helping you to get deal flow. My personal favorite is probably the ones in the top left, right? Accelerators and funding sources. I would say finding other investors that you trust, whether that's an angel network, whether that's being an LP in a fund, whether that's just finding a group of 10 friends. So 37 Angels, when we started, it was meant to be kind of an investment book club. It was going to be me and 9 of my friends. Every month we would get together, we would drink wine, everyone would bring a startup to talk about, and we were going to pick one company to invest in. It was meant to be much more of an informal thing. And it's grown into something much larger kind of 7 years later, but originally that was the intent. And I think it's really important to find people to invest alongside. The other great place is accelerators. So accelerators are kind of like business school for startups. They're usually 3 to 6 month programs where a founder will join usually a cohort of maybe 10 other companies selected, and they will spend 3 to 6 months getting mentorship, getting advice on how to fundraise, getting a small amount of capital, getting co-working space, and at the end they have a demo day. And I love accelerators because it's a great place to find like-minded investors and companies that you're interested in. So a lot of these are sector specific. So Dream It Health, right? You can specifically invest in digital health startups. Workbench only does enterprise SaaS startups. I'm trying to think of other, Excel Food used to be food investors. FoodX does food tech. Future Food does food tech. There are a lot of food accelerators. Start Ed does education technology startups. And so it's a great place to say, okay, I'm really interested in ed tech, education technology. I'm going to maybe mentor at the startup accelerator, and that way I get to meet education tech investors, but I also get to meet founders. And so I really love accelerators as a hub, as well as finding kind of a tribe of investors that you want to invest alongside. There's a question which is how to break into investing, preferably VC without being a founder or having worked in investment banking. So investment banking is actually not real important. I would argue what matters for, I would say at the associate level of venture capital, are a couple of things. The first thing is a perspective on an industry. The second thing is a network. And then the third is a little bit more of a hodgepodge. Ideally, you have some investing experience. Ideally, you have some startup experience. Ideally, you have some technical experience, but those are all kind of nice to have. I would argue a perspective on an industry and a network are non-negotiable, because a lot of what you do as an associate is deal sourcing. So a network is saying, look, I have access to the Wharton Alumni Network, and I have this great group of founders that I can bring to the venture capital fund. A perspective is best demonstrated by writing an investment thesis. So an investment thesis is a 20-page PowerPoint deck, or maybe a 5 to 10-page Word document, which says, here's my perspective on a specific sector. So if I had a $50 million fund, I would specifically invest in the intersection between ed tech and augmented reality. Why? Here are some trends that are happening in the ecosystem. Here are the other players in the ecosystem. Here are 3 startups I think are really interesting. And I find that by forcing yourself to write an investment thesis, you get very smart on a particular sector. And it's a great thing to do to hone your knowledge of a space versus just passively reading, right? There's a reason why we were all forced to write book reports as children, right? It's because when you passively read, it's very different than when you write a book report. I'll be honest, I'm a big nerd. I still write book reports to this day. Every time I read a book, I do like a 1-page summary of notes for myself, because it forces me to digest and kind of chew on the knowledge much more than if I were just passively reading the book. And so that's why I love the exercise of being forced to write an investment thesis. And so that's what I would do, is I write one. It's also a great thing to do to bring to an interview, to say, look, this is my perspective on digital health, or this is my perspective on telemedicine, which would be really interesting right now. What's interesting in accelerator and incubator? These days, they are synonymous, right? It used to be that accelerators were later stage and incubators were earlier stage. These days, I would argue they're synonymous and no difference. Most VCs and angels always prefer a shark to have more traction before they invest, but yeah, so let's, I'm gonna pause there, and I'm gonna answer that when I talk. It's literally like 3 slides. So Valentine or Valentine, my apologies if I'm mispronouncing. I will answer that in just a second. In terms of deal flow and how you source it, most of us source unreferred and referred deal flow. So these are some of the really popular unreferred deal flow sites. For those of you who are angel investors, today you can go onto AngelList, you can go onto Gust and make a little profile for yourself, and you will immediately start getting random people from all over the world emailing you saying, hey, do you want to invest in my company? You can also change your LinkedIn descriptor and say angel investor, and you will start getting all sorts. I have, I think, 1,000 of these pitches in my LinkedIn of people who have tried to add me to pitch, and you will get a lot of deal flow if you say that. Okay, I would argue better quality deal flow comes from referred, right? So maybe business plan competitions, friends who are also investors, accelerators, other investors and founders. I would argue those bottom 3 are by far the best quality. Just to give you a sense, our deal flow is probably 60% unreferred. Actually, these days it's probably 50-50. So our deal flow is 50-50 referred, unreferred. That said, if you look at our portfolio of 70 companies, like 55 are referred in. And the reason why is because those 55 are going to be a higher quality, right? If someone else is investing, if there's already kind of a vetting that's been done. But also, what happens is that we will probably take a closer look. If somebody I really trust says you have to meet with this founder, I'm going to take a little bit of a closer look. I'm just looking at questions. Okay, so just to give you a sense of how wide the funnel is, this is what we look at in a year. We look at about 2,500 companies. We usually meet with maybe 1 in 4, so that's a lot of meetings in a year. And then my team of myself and the investment associates, we're curating the best companies to pitch to our angels. Our angels then pick their favorites, they diligence, and then we write diligence memos, we have our lawyers with the term sheets, and we do 10 investments per year. So we've done this 7 times, which is why we have 70 portfolio companies. And I show this because there is a tremendous amount of deal flow out there. So for those of you who are serious about doing angel investing and you want to do it on your own, you will have to dedicate a significant amount of your time. The other thing you could do is, again, join a network. Okay, I'm gonna take some questions and then I'll do my next slide. So how do venture studios compare to accelerators? So venture studios, the way that they work is they are really joining forces with you to co-found that company. So probably the most famous example is BetaWorks. Interplay.vc is another example. And you sometimes hear these called like foundries or venture studios, and they take much larger percentages of equity, like sometimes up to 50% of equity because they're co-founding with you. And they're really there with you building the product, doing the customer demos. And so it's a very different business model, right? Accelerators are more, we're going to help you fundraise, we're going to help you pitch, we're going to help you do sales, and it's more of a mentorship model. A foundry model or a venture studio model, they're really co-founding that company with you, but it means that they're going to take a lot more equity, be much, much more involved. So very different models. What are some investment theses that we're tackling? Any recent trends? So luckily, if you look at our portfolio, our biggest segments are digital health, future of work, and logistics tech. Thankfully, those things have done really well post-COVID. I would say I'm a big believer of future of work. Future of work is kind of two things. The first thing is the fact that we are all working in a very different way than we did 50 years ago. So a lot of us are part-time consulting, 1099 employees. A lot of us are remote workers, digital nomads. So how do you support that worker? How do you support them from a retirement planning perspective? How do you support them from a benefits perspective? So there's a whole space around future of work, which is how we're all working now in distributed teams. And then the other half would be basically robotics, automating jobs. I'm much more in the first half of future of work than I am in that second half, but that's a thesis we believe in very much. And thankfully, it's a sector that's done really well, given everything that's happening in the last 3 years. But those are some of the trends that we invest in, although I would say I'm not a trend-based investor because trends tend to be lagging indicators. For 37Angels, do you prefer to be referred before investing, or do you meet with them before? Yeah, so we will look at both unreferred and referred deal flow equally. It's obviously, like I said, we might take a little bit of a closer look if it's referred in, but we look at both. What's your perspective on the e-commerce industry, more specifically on funding a startup that aims to help online sellers? Yeah, I think it's great. I will say it's a very crowded space. Literally looked at a company yesterday. I would say at least once a month, I get pitched a company that's solving that problem. Omnichannel is difficult. Getting customers to convert is challenging. And so what I would say is it's a great space to be in. It's really competitive. And so for those of you who are in that space, when you're walking into that investor pitch, you really have to know your indirect competitors well, and what's there. Our venture foundries, and studios similar to venture builders. I don't actually know the term venture builders, but it sounds very similar. What is the range of your investments as an angel? Yep, I will answer that a little bit later. What are your thoughts on angel syndicates? Okay, so I'm going to answer these 3 questions a little bit later. Let me do what it is that investors look for in diligence, and I'll definitely take more questions. So I like alliteration. So we look for people, problem, progress, and price, very much in that order. People first. The earlier stage of an investor you are, the more the team is paramount. Another P. So people, what matters there? What matters there is that they have relevant domain expertise, right? So if you think about what people think about a lot in team, I'll often get the question, do I need a technical co-founder? Do I need a CTO? Well, it depends on what your company is doing, right? So if you look at a company that we invested in called Board Vitals, they basically create medical board exam questions. Doctors pass the medical board. So for those of us who studied for the SAT or the GMAT or the GRE, we remember taking lots and lots of practice tests, right? I'm sure we all did. And when we did that, we were taking questions to try to get higher scores on the standardized test. This is the same thing, but for medical boards. And if you look at that team, we spent a lot of time diligencing one of the co-founders on his ed tech background, but we spent a little bit less time diligencing his tech background. Because if you think about it, technology is not at the core of that business. Again, some of us probably took the GMAT on paper, right? Some of us took the GMAT online. I certainly did my practice questions through a book, which maybe sounds insane to some of you now. But even for those of us who took the GMAT online or did practice questions online, I'm sure you don't remember the platform. You weren't like, this is the most amazing test prep platform ever. But what did you care about? You cared that the questions were really similar to the ones that were on that standardized test to help you to get better. And so his ed tech background was much more relevant than his technical background. Contrast that with Mads Digital, another company we're invested in. If you've read a magazine on a tablet, they're the technology behind that. Their clients are Forbes, Bloomberg, all the big media brands. Technology is absolutely at the center of that company. So in that case, we actually had a technologist diligence their CTO and be like, do these people really know like the tech stack they need and the skill sets they need to do this? And so it's really about knowing your domain expertise and then spending the most time diligencing the team's knowledge in that area. So we spend a lot of time there. The second thing within people is complementary skill sets. So we want a really complementary team. So I don't want 3 guys who all went to Duke, who all played lacrosse, who are all ex-lawyers, right? That is not a complementary team. We want diversity in all sorts. So obviously we like diversity from a gender and race perspective, but even like age, right? I don't want to see all 20-year-olds. I don't want to see all 50-year-olds. I want to see subject matter complements. I want to see, you know, one person's an introvert, one person's an extrovert, right? All that kind of stuff. I'll give you an example. We looked at a company recently that essentially does FICO score for businesses for B2B underwriting. And the founder is a data scientist, which is great because the company is very much rooted in data science. And he had 7 data scientists on his team. And I asked, who's the next person you're going to hire? And he said, I'm going to hire a data architect. And so he was just investing so heavily in data. And I would argue that's over-investing. There wasn't enough complementary skill sets on that team. I actually wanted him to hire a salesperson, probably as employee number 4, not employee number 8. So those are the 2 things in people. Relevant domain expertise, complementary team structure. And then of course I need to look at that founder and believe that he or she is going to win in the space. I'm going to take some questions before I move on to problem, progress, and price. I am going to, okay. You know what, I'm going to finish out these 3 and then I'll kind of break and take these questions. Okay, so from a problem, we are looking for a really large market that they're playing in, and we're looking for an attractive competitive landscape, and we're looking for understanding of the customer. So large market, I think, is self-explanatory. Attractive competitive landscape, I'm assuming, is also self-explanatory given this audience. I think the thing that's a little bit more new, so we always ask the question, who is your customer? You know, and a bad description is women, right? Or millennials, right? Or now Gen Z is all the hype. A much better description is, you know, here's their age, their income level, their education level. Here are their lifestyle choices. What magazines do they read? You know, what grocery stores do they shop at? Do they shop organic? And really important, what is the pain point that you're solving? So if you think about green juices, right? We've been pitched a gazillion healthy beverages. If you think about healthy, like just green juices in particular, and I were to ask you, what's the problem this green juice startup is solving? You could say, you know, I'm running around New York City all day long and I can't get fruits and vegetables into my body quickly enough. And so it's really convenience is the problem you're solving. Or it could be weight loss, right? Maybe some of us have, you know, gained a little bit of weight in quarantine. We're trying to lose weight. And so the problem you're actually solving is weight loss. Versus maybe I'm caring for somebody who is going through chemotherapy and they need nutrient-dense foods and they don't have an appetite and they have, you know, mouth sores. Very, very different problems and very different indirect competitors, very different customer, very different marketing message. And so we look for founders who really understand the problem that they're solving and can articulate that in a focused way. Progress, I think, is going to answer some of the questions that have been asked, which is we want there to be some degree of progress. So the question I always get asked is how much revenue and customers do founders need to have before they can pitch a seed investor or, you know, a Series A investor? And it's less about it, especially in seed, it's less about like X number of dollars or X number of customers. It's much more that you can approach a seed investor once you have a repeatable customer acquisition process. So once you can tell me that I got the last 5,000 customers through Facebook ads and Instagram ads, and I know that it cost me $30 to acquire them, and I know that they on average spend, you know, $150 with me, that's when you're ready to approach a seed investor. Because as a seed investor, I'm giving you a bunch of $30 customer acquisition costs to go get a lot of $150 customer lifetime values. So that ratio between CAC and LTV customer acquisition cost and lifetime value. That ratio is really important. We need it to be a minimum of 3 to 1. Again, we need lifetime value to be 3 times customer acquisition cost at a minimum. And once that's happened, you've built a customer acquisition machine, and I'm just funding that customer acquisition machine for growth. So I would argue that the amount of progress you need to have is when you can tell me that I know how I got my first 1,000 customers, so I know how I'm going to get my next 1,000,000. So that's when it's the right time to approach an investor. And then price. We want a fair valuation, which is a whole class in and of itself. Okay, let me get to some of these questions. So most VCs and angels always prefer a startup to have more traction before they invest, but most founders need some of those funds to, so it's just chicken or the egg, right? I need funding to get traction. I need traction to get funding. So first of all, what has emerged is because seed is becoming harder and harder to get, what's emerged is this category of pre-seed investors. So let me just list a couple of them. A4, Brooklyn Bridge Ventures, Precursor. There are more, right? But these are specifically pre-seed investors who will invest earlier than a seed investor. So that's one. The second thing is you can do what's called like showcasing your traction. That doesn't necessarily mean revenue. So for example, if you're B2C, show your waiting list. You can say, look, we have a website where we described our thing. We have 2,000 people on that waiting list. We just invested in Attention Grace, which is a newer, better way to do incontinence for the elderly. And they had like 9,000 people on their waiting list, pre-revenue, right? But we invested in that company because they were able to show us that I know how to convert whatever it is, a mailing list into at least somebody willing to give me their email address, right? And then some percentage of those 9,000 will convert over. Kickstarter is another great thing to do for B2C, right? Kickstarter or Indiegogo. On the B2B side, what you can do is do letters of intent, right? So we looked at a company that does SMS messaging to book fitness classes. So if I wanted to take a Pilates class tomorrow, I could text and say, hey, is Brooke available to teach Pilates tomorrow at 3 o'clock? And through SMS, I could actually book a session. And they didn't have any paying clients, but what they did have was they had 81 leaders of kind of Pilates studios and yoga studios say, yep, I'll send an email to you saying, I'm interested, right? It's a kind of a letter of intent saying that they'll get there. You can also show your pipeline on B2B. Your pipeline would look like, we have had meetings with these 20 people, right? We've had second meetings with these 8. We're in contract negotiation with these 2. Those 2 contracts are worth X. And it starts to approximate traction. Okay, so that's that question. What's the range for investing as an angel? How much do you need to get started on your own with an angel network? So with an angel network, most angel networks need you to do at least 1 investment per year. And most founders won't take less than a $25,000 check. That's most angel investors. And then to do what's actually, I answered this question a little bit later on. I answered the traction question. What's your perspective on venture scouts? Venture scouts are people, actually, if you just Google Sequoia Scout Program, they have a very popular one, and they actually wrote a nice article about how they run. What you're basically doing is you are scouting for finding good deal flow. And it is a great thing to do to show to that venture capital firm, hey, I have value to add because I'm going to bring you great deal flow. And often it's used as a recruiting tool. There are lots of different ways to be compensated. You can be compensated, by month. You can be compensated by deal, or you can get a percentage of carry, or you can be not compensated at all, right? Because you're just doing it to hopefully ingratiate yourself with them to maybe one day get a job. I think that they are oftentimes a higher value add to the fund than they are to the scout. That said, though, if you can find a place where you're a venture scout and you get to listen in on their meetings and sit in on their calls and learn, I think it could be a good value add. But a lot of the times, they are a higher value add to the firm than they are to the scout. But there are lots of good programs out there. I think you just have to ask, the questions I would ask to determine if it's a good program is, first of all, talk to the other scouts and ask them how much time you get to spend with the team. So if you're only sending them deal flow and you never get to talk to them, I would say low value add. If you get to meet with them, sit in on maybe like the Monday partner meetings, I think they can be really value add. How much do angel investors take in equity? So right now, in the US, the average seed stage company is worth $5 million. and the smallest angel check is 25,000. So typically I would expect half a percentage point, right? Or 50 basis points. So I put 25K into a $5 million company. I now have 50 basis points, or 0.5%, or 0.5% of a company. That's a very typical ratio. We have a pitch forum tomorrow, and somebody wanted to join. It's not too late to join. You can register through the Eventbrite. What are reputable sources and tools for market research and finding the key players and companies for due diligence? I would say that my reputable resource is people, right? So I think finding people that are subject matter experts in the area that you want to invest in is really important, right? So literally just like create a little Excel spreadsheet and say, okay, I'm deeply passionate about logistics tech, right? Who are the people who know trucking well, who knows aviation well, who knows naval well? Who knows, whatever the case may be, and just start to create your little subject matter expertise network. And I find that is by far the best resource for diligence. It's not about like reading all the books or Googling. I think it really is about having a network of smart people. And that's why, again, I have a bias towards angel networks, because I have 85 brilliant women that I can call upon to say, hey, who knows about composting, which we just had to ask that question, and somebody can raise their hand and say yes. What was your first investment as an angel investor? Yeah, so my first angel investment was an accident. So, hey, Linda.
Hi, sorry about that.
No worries. It's nice to see your face. So my first angel investment was in 2008. Great time to be angel invested, by the way. It was one of my best friends. We were each other's bridesmaids. We've known each other since middle school. She had filmed a movie called Hiding Divya, which was all about, it wasn't all about, but one of the outputs was to increase the awareness of mental health, specifically in the Asian community. Because, Asian Americans, like a lot of immigrant communities, they don't really talk about mental health. It's more about like kind of gritting your teeth and getting through it. And I really believed in this film, and so I invested in the distribution rights of it. So I wrote a $5,000 check, and all of a sudden I was an investor. By the way, I lost all my money, but I'm very glad I invested in that film. But all of a sudden I was a quote unquote investor. I started getting these emails and getting invited to events, and I really didn't know what I was doing. And so I was kind of bumbling my way through. And then in 2011, 12, I said, okay, I want to be a little bit more serious about this. I read everything that I could. I took every class that I could. And the next year, 37Angels was born. Basically, I was like, I don't want other people to have to go through what I had to go through in terms of the learning curve. And so that's why we created the investment bootcamp, to teach people how to be angel investors. And that's why we have a focus on closing the gender gap in angel investing. How do most people get started? I would say most people get started very similarly, right? They write a check, they hear some events, and they write that first check. And then I think by joining an angel network, I do encourage all of you to attend if you want to join an angel network, attend an event of 2 or 3 angel networks that are interesting to you. And that way you get to see who's in the room, you get to see their deal flow, you get to see their process. For example, like I really like Ostia Angels, but early on, I don't know if this is still true, their meetings were, like lunchtime. I was like, I will never be able to make that meeting. And so that didn't necessarily work for me. Does 37Angels invest in fashion-related spaces? We would invest in fashion tech. We would not invest in a fashion brand. We pretty much invest in technology. Do you have networks that would invest in minority-owned VC fund? So yeah, a couple of, actually, I have a slide on affinity ventures, so I will get to that in a second. Can you please repeat that on customer acquisition? Your customer lifetime value needs to be 3 times your customer acquisition cost. So if it costs you $10 to acquire a customer on Facebook, that customer has to bring in at least $30 worth of revenue to the company in order for that customer to be a viable customer. What is your thought on pre-seed and pre-revenue startups? I feel great about them. I think pre-seed is filling the gap that is necessary because seed has become quite big. And so I think it's a great thing that they exist. What I would say, so we will invest pre-revenue, but we won't invest pre-data. So even if you don't have any revenue, you need to have data, right? So maybe you have an app that's free, so you're pre-revenue, but I want you to have data. So, how many daily active users do you have? When somebody download your app, what percentage of them still have that app downloaded a month later? You know, how long was each session when they log in? And so I still want you to have data even if you're free revenue. And I think that's true of most investors. How do you think about market sizing? Oftentimes in venture, if it's not $1 billion opportunity, it's not worth investing in. Yeah, so most angel networks, I would say the absolute floor is we need to believe that you can make $25 million a year in revenue in steady state. Absolute bare minimum. Obviously 100 million in revenue is better, 250 million is even better than that. And so that's what I would say we would need as a bare minimum. And then if you're going after venture capital, the larger the fund, the larger of an exit they need you to have. So if you're pitching Sequoia that has $8 billion under management, they need you to be able to make $1 billion in revenue, right? So you want, market sizes tend to correlate with the size of the fund, but I would say they need to be large spaces. And the reason why people say the $1 billion opportunity is because you're not going to capture the whole market. And so that's why we say $1 billion opportunity. I will share the link with the organizers, event, right, and slides. And I'll also put a list of pre-seed funders into this slide deck. Today there seems to be an increasing interest by angels in price rounds, while founders are interested in convertible notes. I think that the debate between priced equity and convertible notes are very, very silly. Founders think that convertible notes are founder friendly because they get to quote unquote defer valuation. That is not true. If you have a cap on your convertible note, which you should, you have put a valuation on your company. So we are completely neutral. Right now in the ecosystem, we're seeing maybe 60% convertible notes, 25% priced equity, and maybe 15% safes. Totally fine with all three, so long as there is a cap on it. Advice for e-commerce retail companies appealing to investors. I don't have a great answer for you other than know your competitive landscape really well, know your customer problem that you're solving very well, and also know your unit economics very, very well, especially around logistics, right? So, you know, like, we get pitched a ton of ice cream companies. Ice cream is really, really tough because the logistics, especially if it's direct to consumer of ice cream, is really, like, there's a reason why Jenny's ice cream is, I think it's like $10 or $12 a pint. It's so expensive because they have to pay for like the dry ice and all that kind of stuff. And so it's very hard to make that math work. And so you need to know your unit economics really well. What ended up happening with your best friend's pursuit of filmmaking? She's still doing it. And she is wonderful filmmaker, and she's actually coming out with hopefully a Broadway show in a couple of years, which I don't think I'm allowed to talk about, but I actually got to see the like pre-showing that she was showing to investors. It was amazing. And so she's still very much in the industry and very successful and doing well. As a company trying to raise a Series seed preferred round with a lead check of $1 million, how would you go about raising capital? Yeah, so what I would say around going around to capital is typically it takes 3 to 6 months to raise a round, and you're probably going to have to talk to like 50 to 100 investors. So what you do is you create an Excel spreadsheet and list all of the VCs and angels you know, and then go onto LinkedIn and find out your target funds, I should say, and find out who you have second-degree connections with and ask them to make introductions. And then you pitch them. For those of you who are interested in a good slide deck, so if you go to SlideShare, and you look up my name, I have in there a 10-slide pitch deck that you can download, which is what I think is a good pitch deck. What top 3 angel networks would you recommend looking into? So Wharton Angel Network would be one. 37Angels would be the second. Empire Angels is a great network in, actually, you know what? I have a list of angel networks. I will show them in a second. Once you invest, how often does the company typically report back on progress? Usually monthly or quarterly is how often the founders report back on progress. What are your thoughts on the future for remote work? I think it is wonderful. And I think while it is a terrible experiment that we've all run in the last 3 months, I am fascinated about the ripple effects longer term for remote work, for distributed teams, for more kind of geographic diversity. And I think it's a great thing, and I'm very bullish on the space of remote work. On the 3x LTV to CAC threshold, is there a time value of money? No. How soon does a 3x need to be realized? Sometimes you'll hear people say that they want the CAC paid back within 6 months or 12 months. I don't see people getting too fussed about that early stage. I would just say have a good ratio and you're good. Do you see morals and ethics in your brands and supply chains? Yeah, we are not an impact network. But when we went back and looked at our 70 portfolio companies, a third are definitely impact, a third are definitely not, and then a third you could kind of argue either way. And so it is something that's important to, certainly to our members, and I think it's great, and I'm actually going to show you specifically an Impact Angel Network in a second. Advice for company valuations. Yeah, there's not software. So for those of you who want mathematical ways to value a company, you can Google the scorecard method, the risk factor. I'm typing in the chat window. It's risk factor summation method, the VC method, and the dilution method. If you want to do some Googling, you can look up valuation. That said, the way valuation is really done is through the gut and through negotiations. And so what that can do is it'll give you some mathematical ways to calculate valuation, but the real way to learn valuation is to go to a bunch of pitch events, talk to a bunch of smart people to get a sense of what is happening in your local ecosystem, your sector for your stage. What's the assumed time to reach 25 million in revenue? 5 years. Not that we'll hold you to it. If there's a lot of competitors and strong revenue potential, how do the angels look at it? We look for you to have a unique value proposition, a unique way to approach the market. So for example, healthy beverages are very popular right now. And we looked at a company recently that does healthy teas, right? It has like turmeric in it. Turmeric's very popular these days. And the product itself was somewhat interesting, but what was really interesting was her go-to-market strategy. So she had a completely B2B go-to-market strategy where she was going after all the tech firms, you know, like I was at AppNexus recently doing a training, and they have this amazing kitchen, right, that's fully stocked with like healthy snacks and peeled snacks, dried mango and Lara bars and Kashi Goleen cereal and healthy beverages. And so they were only going in through a B2B route, and then B2C would follow. And it was like a very unique way that they were entering the market. So that's an example of crowded market, but that founder had figured out a unique way to enter it. What's the best way to find angel investors in a particular area? Yeah, so if you go to AngelList, the great thing, like if you were just to Google like Angel List Hong Kong, which I did this yesterday because I was speaking to a group of Hong Kong investors, it'll actually just, one of the first 2 links will just show you all the angel investors in Hong Kong. So that's a great resource. So yeah, AngelList. Can you share some thoughts on how the VC industry is recently doing under COVID? So I'm going to pause. I'm going to go through a few more slides, and then I'm going to answer some of your other questions. I'm also just really quickly looking at time. Okay. So what are some questions you should answer for yourself before starting to invest? So the first thing is to figure out how much control do you want to have. So do you want to have very little control and give your money to a GP to have him or her manage on your behalf? Or do you want to be a solo angel with all the control in the world? There's no right or wrong, right? So I'm obviously in an angel network. I think I'm personally invested in like 25 companies, but I'm also invested in 3 funds to get that power of diversification. There's no right or wrong, but there's a decision you need to make of how much control do you want to have on your investments. The second thing is, are you comfortable with the risks? Obviously, angel investing is fun, financially rewarding, all that kind of stuff, but you could lose all your money. These are highly illiquid investments, right? So your money's going to be tied up for 5 to 10 years. Right now, on average, from seed to exit is 8 years. It's not that diversified. Again, at a minimum, you tend to have to write a $25,000 check. You pretty much have no control, right? Because you're a minority shareholder. And it's just a very emotional investment. You should also ask yourself where you want to focus. So this is a slide I mentioned where I have some different types of angel networks. So there's geography-based angel networks. There are sector-based ones. I like Life Science Angel. Investor Circle only does social enterprises. If you like prop tech, Metaprop is great. They're fun, not an angel network. If you want to specifically invest in formerly incarcerated founders, you can invest in Defy Ventures, and they only invest in formerly incarcerated founders. So there literally is a flavor for whatever area of the world you want to put your money into, whether that's a sector, it's a geography, a demographic, a founder, a stage. New Voices Fund only funds, I want to say, Black female entrepreneurs. New Voices Fund. X Factor Ventures, which is spun out of Flybridge, only invests in female founders. I'm trying to think of all the affinity ones. Gangels, which is, they only invest in founders in the LGBTQ community. Start Out is an accelerated focus on LGBTQ folks. Yeah, those are the ones I can think of, but there are so many. So whatever flavor part of the world you're interested in, I promise you there is an angel network and or fund to meet those needs. Defy. Okay, so in terms of financials, I think it's important to know if you're going to put money into this ecosystem, if it's a fund, right, you are going to have to obviously pay that GP money to manage your money, which is usually a 2% management fee and 20% carry. To be a part of an angel network, you have to pay a membership fee. And then from a returns perspective, what every venture fund is shooting for is 20% IRR, which equates to 3x in 10 years. So they want to take, if you give them $1 million to invest, they will turn your $1 million into $3 million in 10 years. That is their goal of every fund. The reality is only the top quartile of funds are doing this, but that's what every venture fund's goal is. If you're joining an angel network, or if you are maybe thinking about being an LP of a fund and they can't tell you these numbers, ask them how many acquisitions they've had. So we've had 7 acquisitions out of 70 companies. Ask them how many failures they've had. And then ask them the percentage that have raised their next round. So right now, if you raise a seed or a Series A, you have less than a 10% chance of raising your next round. It's somewhere around 7% right now because there's so much money in seed. Right, for us, we're at about a third. A third of our seed companies have raised a Series A and or Series B. So that's a good early ratio. Our portfolio IRR is above 40%, but ask those questions to vet the GP and or the angel network. Please, please, please diversify if you're going to invest in this space. The first is to commit to the asset class. So if you're going to be an angel, I would strongly encourage you to be prepared to write 10 checks. Now you can do that over 3 or 4 years, but be prepared to write 10 checks to get some of that diversification. If that feels too expensive, you can do equity crowdfunding. There are hundreds of sites that do equity crowdfunding where you can invest 1,000 into a company or 5,000 into a company. You can invest in accelerators and you can invest in funds. Okay, last slide on resources and I'll take questions. So I'm a professor, so I have homework for you. So the first is to engage in the community. Let's just start going to events so you can hear pitches and get to know the ecosystem. You can learn about the network, right? So you can read books, you can listen to podcasts. If you're interested in taking our investment bootcamp, you can go to 37angels.com/bootcamp. If you put WAFFA in the how you heard about us, you get $500 off. And then you can join an angel network. If you want to know about accelerators that are specific to a sector that you're interested in, we have them all listed on our site. Find folks to invest alongside. We have a ton of resources on our site. We have resources for female founders, and we also have a glossary. We have more blogs, so much. I will leave this slide up in case people want to take notes while I take questions. I realize I'm talking a little bit quickly, but I'm like looking at the questions coming in. I'm like, I have to get through this. Okay. How is the VC industry doing under COVID? It's actually doing fairly well because we may or may not see the downturn for a little bit of time. We only had like 10% of down rounds in the month of April. So I think a lot of us thought that valuations would come down a lot. That actually did not happen. And I think it's a great time to be an investor, so long as you have capital to invest. I think it's not going to be the easiest time to raise a fund. Just to give you a scary fact, last year, more than 600 new venture capital funds were started, which is insane. So there are a lot of funds in the space. Tips for getting started. Yep, do all the things on this page is what I would say. Is the pitch done under confidentiality? No. So usually pitches are done in front of 50 or 100 members of the Angel Network. We do not sign NDAs because there's very little that we would be able to take from a pitch deck to go and, for example, steal your idea. What is the possibility of funding with an MVP at pre-launch? Yeah, so what I will do is add a slide on pre-seed investors before I send this out. Perspective on investing in social impact ventures in Africa. I'm not a great person to answer that question, so I'm going to skip that one. What is the average return? Yep, I answered that question. So our goal is 20% IRR or 3x in 10 years. And on average, it takes 8 years to exit a seed investment. How should angel investing fit into your overall investment strategy? No more than 5 to 10% of your investment portfolio. This is an incredibly speculative asset class, so no more than 5 to 10% is my recommendation. I answered the valuation question. Do we recommend funds if we're not interested in directly investing? So if I'm passing on you for a very specific reason, like it's too early, it's too late, or it's a sector we don't invest in, yes, I will pass on that investment. But if I pass because I don't like the competitive landscape, or I pass because I don't think the founding team has the domain expertise, I'm not going to make that recommendation to another investor. Any suggestions for angels supporting global investments? So one is Venture Out New York is an organization that specifically helps companies, international founders get funding in New York, San Francisco, Boston. And then I would say if you go to this URL, 37angels.com/accelerators, we have a list of global accelerators there. And I think accelerators are a really, really great place to start in terms of getting support. Founders sit in a pitch tomorrow. So founders, unfortunately, can't sit in on the pitch tomorrow. It's mostly geared towards angels. What are your thoughts on angel syndicates? Yeah, so I think, so angel syndicates I would put into what I would call like an angel fund. They're kind of somewhere between an angel network and a VC fund. I think they're a great thing to do because you get to learn a lot. And I like angel syndicates so long as you get to learn. The main drawback is it's decision by consensus. And so you have to trust the people around you to make good investments. Based on your own experience, what is the success rates of my own angel investments? Yeah, so our portfolio IRR is over 20%. My own personal portfolio has a higher IRR, which is, I guess, good. We have had 11 of 70 companies fail. Yeah, so those are my thoughts on that. Out of the companies an angel fund invests on average, what is the percentage that reach? Okay, so the 20% IRR target is the portfolio. So if I say I put $1 million into 70 companies, what does that $70 million turn into? So that's the IRR I'm calculating, not the by company. But to give you a sense, what most people will say is if you invest in 10 companies, a third to a half of them will fail. A third of them, you'll maybe make your money back, maybe double your money back. And then 1 out of 10, you'll make 10x, 20x, 50x. That is kind of a typical portfolio construction. What is failing? Yeah, running out of cash, the founders imploding, lots of reasons. If you want to look up the reasons why founders fail, and you look up the venture capital rejection form letter, it is a great way to look at all the reasons why founders fail. What have I learned from the 11 companies that fail? It's hard to say. I've tried to go back and look. A lot of them failed due to poor timing, right? If I had like a crystal ball answer to that question, then I would be the richest person in the world. But what I would say is team is, I think over time, my percentage allocation towards team has increased even more, right? Which is it's really about the team. And so I spend even more time diligencing team is what I would say. Does 37Angels work with other angel groups to syndicate deals? Absolutely. We work with VCs and angels. We have a list of about 300 investors that we syndicate deal flow with, which is, I think, a good thing. How much money should you have saved up before venturing into angel investing? So legally, you can be an accredited investor with $1 million of investable assets. Practically speaking, I would say 3 to 5 million is my recommendation. What are some companies on your FOMO list? Actually, so let me see. I want to be, okay, so we have 2 minutes left. So I'm looking through because I'm not going to answer all of these. Whew. So I guess we'll talk about FOMO at the end. That's a fun one. So the companies that I wish I had invested in. So we didn't invest in Coffee Meets Bagel. That's a dating app. That would be one. And then actually, if you did, this is actually a good resource for me to share with you all. So if you go to Crunchbase and I were to look up Coffee Meets Bagel, this is all public information, by the way. We could have invested in their seed round. And they've done really well. We didn't invest. That's one. Warby Parker is another one. So I was at McKinsey for several years post business school, and Neil Blumenthal was a summer associate that I trained, and didn't get on Warby. That would be one that I certainly regret. Yes, I will share the slides. So legally, you need to have $1 million to be an accredited investor, but I would say that 3 to 5 million is probably a safer number to have saved up to do angel investing, but you can do equity crowdfunding if you're not at those levels yet. I'm going to stop talking. I realize I just talked really quickly for an hour, and I'm sorry if I didn't get to your question, but I hope that you found this informative. Thank you to the team for having me, and stay safe and healthy out there.
Thank you so much, Angela. Seriously, I think I've taken entire classes that didn't even cover as much information as that past hour, so I'm reeling from that. I think just to follow up on the commonly asked questions in the chat, we will be sharing a recording, and it sounds like the slides will be shared, so we can keep this going. Thank you so much to all of the attendees. This was a record for us in terms of signups. We had more than 500 signups, which is pretty crazy. And tons of questions. So thank you guys for being such a great audience today. And thanks again to Angela for putting on such an informative, wonderful session for us. And I'll let everyone go. It's 4:01, but thank you guys so much and have a good day.
Have a good one.